We are live. Welcome to the October 12th, 2021 Portfolio Builder update. We're going to review our 4 strategies, the returns we've made on a monthly breakdown, and exactly how to invest your money today. Highlights: the high risk, high return portfolio is now up 16% in October. Our Warren Buffett American-based strategy, the Safe Alpha portfolio, is up 7%. The Ray Dalio Global Growth Pro portfolio is up 7% in October. And then our Bitcoin loaded Bootcamp core portfolio is now up 13% in October. Now, if you're on a free trial, we're only giving you access to the high risk, high return portfolio, now up 260% year to date, outperforming the S&P 500 16 times. And the current recommendation is to buy. We're on the brink of a melt up. We're going to explain all this. And I do think markets are going to climb a wall of worry all the way till about March. So we'll take a look at that. Now, if you're just getting started on a free trial, I highly recommend you call Dean Gallagher for a detailed step-by-step walkthrough of the current trading plan. And while the email goes out with a sample $10,000 trade alert, Dean can actually send you a customized screenshot for the exact amount of money you want to invest. So call Dean, 505-322-7515. You can tell him what you're currently invested in. He can show you what's most likely going to give you pain as we enter winter and how our strategy is far better. Now, I do want to cover a few market predictions coming up here. So last week, our predictions were dead on. We predicted that essentially the debt ceiling would be suspended. And boy, oh boy, did that happen. McConnell caved, gave the Democrats a $500 billion bonus to try to get a budget through. So we can see just how corrupt all these politicians really are. They're all on the same team. The other prediction we had was that the jobs report would be very weak, making it less likely there'll be tightening of monetary policy in November. So those came out completely correct last week. We're having some great gains in the portfolio. I have 5 new predictions for you today, which we'll see how accurate I can be as we come into these critical months. Okay, tomorrow we get a new CPI print. Now the CPI, I believe, will fall slightly Wednesday. Okay, and that's because energy prices really didn't jump till recently, which will make it go back up next month. And we've seen a very weak labor markets and these mandates. So I believe we're going to see CPI actually fall. There's some signs of some weakening in shipping times. And so bottom line is we're going to have a small pullback in CPI this coming month, and then it's going to continue to remain sticky and go hotter as wages and rent and energy start to really put some pressure on the Federal Reserve. So we'll see how that goes. Tomorrow I'll cover it on my Friday update. Next part of this prediction is that I believe the mandates are going to cause weak jobs growth in October, and that we are not going to begin tapering November 3rd. Now I'm going to caveat that if the Fed does taper November 3rd, and it will be before they have jobs data, I do believe it could create a stock volatility event or a bond volatility event. Very hard to predict which one, but either interest rates rise due to less buying by the Fed, which will eventually create volatility in stocks, or the opposite, stocks sell off and bonds get a bid. So I'm expecting, if there's a tapering event November 3rd, either your MOVE index goes crazy, which means the TLT tanks, or the stock market tanks and the VIX goes up. And that's if we taper November 3rd without robust labor growth. And again, we're just not going to have that data in when they have to make the decision, which is why my best guess is they delay it until we have further data. Prediction number 3. Stocks, crypto, and commodities continue to melt up at least until December if labor growth is weak in October, which means the Fed's going to keep not tapering, and all this talk of tapering November 3rd is just that talk with no walk. Prediction 4, Jayapal Manchin agree to a $2 trillion stimulus deal by mid-December. Okay, so we're slowly seeing these two come together and rather go for the $3.5 trillion deal over a decade. They're going to shorten it perhaps to only 5 years. So same spending, same plans getting pushed through. Both will probably get a few things that really benefit them. Jayapal with lots of social nets, free money for the people, Manchin with keeping his state's coal interests intact. So there's a few things they definitely disagree on, but at the end of the day, I think this will pass and that the markets will be patient until mid-December. Prediction 5, Bitcoin hits 100 grand and oil 100 plus by March of 2022 as tech flatlines or falls. So I think we're going to have a very similar repeat to last winter and Q1. Now remember, the stimulus really failed to work after Q1. So I do believe that they're going to have to pass more stimulus next year. And that we, again, potentially run into some of the same problems we saw for much of this year in passing stimulus. So we may hit a short-term top in Q1 of 2022 in a lot of the assets I'm looking at, assuming the Fed doesn't taper, labor markets remain weak, and they pass all this stimulus. So that's what I'm coming into predictions here. Okay, so we will review the asset allocation breakdown and detailed monthly profit loss breakdown at the end of this video for each strategy if you're on a current active trial or a paid member. Now, if you're not a paid member or your trial's ended, you're going to have that section of the video cut off. So again, call Dean to gain access if you're expired and watching this on YouTube. If you are on a free trial, call Dean to get a detailed walkthrough of how to follow our trading plan. Again, you're getting that high risk, high return portfolio during your free trial. If you upgrade, you'll gain access to all 4 of our turnkey strategies. And Dean's number is, once again, 505-322-7515. All right, let's talk about the key market risks to focus on, how this could impact our strategy and how we would alter our strategy on a dime if these begin to play out. Okay, so we need to realize there are now 7 million Americans who lost unemployment benefits 2 weeks ago. Will they return to the workforce in October? We're just not going to know when they have to make the tapering decision in November. But when I look at the effects rippling through the mandates, I think it's highly unlikely there's a robust labor recovery in October. I'm anticipating a lot of sickness to begin in November, December, January to further suppress labor recovery. So I'm not too worried about labor markets recovering and putting pressure on the Fed to taper until probably February, March, April of next year. That's my best guess right now. But we got to remember, there's 7 million people with 10.5 million job openings. So the potential for a massive job growth is there. Just the policies being pushed through government are suppressing this. Other news, 3.4 million people quit their job last month in search of better pay or work from home luxury. Again, will this change as 7 million people fight over 10.5 million jobs? So this is all yet to be determined. Another big movement that could become very important is this call-in sick, which we're seeing with Southwest Airlines. Could start a massive trend to derail supply chains and implode corporate earnings. Again, due to mandates. Now we have a lot of African-American celebrities standing up against these mandates. This is really starting to change the tides. So very interesting to watch this play out with a New York basketball star as the recent headline on that. And again, I think the single biggest risk of all, outside of the Fed tapering, without a strong economic recovery, is Jayapal and Manchin having a showdown on the reconciliation bill. And if that doesn't pass by mid-December, absolutely, you're going to have a debt ceiling crisis and a stock market crisis at the same time. So I think there's going to be a huge issue. And furthermore, throw some extra fuel to the fire. The medicine being used to fight the sickness will stop working for much of the American population by mid-November. So hospitals could very well become overwhelmed and cause new lockdowns, I believe starting as early as mid-November. This could be used for political purposes to help create a crisis to push stimulus through. So again, a lot of things that could go wrong. We're on top of the ball for you. I believe the September sell-off was only a prelude to a larger potential crash by December if the debt ceiling and new spending continue to be blocked. Now, we did get a $500 billion freebie from McConnell to buy some more time. So the same pain you saw in September could be returning if we don't get some progress. Failure to close a deal in December likely to cause a stock crash in our UVXY VIX position. Protects us against this with 1,000% gains last time we had a crash. Here's that look in March. If you had 10% of your portfolio in UVXY, the other 90% could have gone to zero and you still walked away with a 10% profit. So it just shows you how powerful the VIX can truly be to your portfolio to absorb market shocks and give you the confidence to remain long. We have a comment from Ed, 3 of his vaccinated coworkers. I gotta be careful with that word. We're all out with, yeah, it just doesn't work for very long. So other key news, bad news out of China keeps pouring in, but we got to keep in mind Chinese imports and exports are at record highs. I say buy the dip in China. Charlie Munger, Buffett's partner, doubled down on Alibaba, headline this week, which again, we have a huge exposure to with both EDC ETF for Pro and FNGU for the Bootcamp core strategy. It would be ironic for China to crash global financial markets in an effort to clean their economy on the back of the best year economically in history, unless that's the plan. Keeping a close eye on the CCP. As you know, I am always suspicious of what their intents are and ever since the lockdowns, we know they've been up to a lot of funny business. Chinese real estate bond defaults continue to hit headlines. And now the CCP, Chinese Communist Party, is cracking down on its own banking sector. When will the smash and grab by the Communist Party end? Keeping a very close eye on this. Okay, so what are some signals to give us an idea that a crash is coming? I've lined it out with 4 critical markets to keep a close eye on, which we will review every Tuesday and Friday in this webinar, so you will not have to worry about it. The dollar DXY trading over 94.50 is a red alert. Guess what? We just breached that while I was making this PowerPoint, 94.51. If it goes to 95, I'll be very worried. Okay, this is showing weaknesses all across the globe as people are buying up the dollar and selling their local currencies. So it's at a critical level. To see the returns our portfolios had with the dollar rising is phenomenal. I believe the dollar will come back down and our portfolio profits are going to skyrocket when that happens. And I find it very, very unlikely the dollar goes much above 94.50 and especially above 95. If it does, we have to reevaluate what's really happening and probably have to do with contagion coming out of China due to bond defaults. Okay, next one we're going to look at is the ETF EEM. It's about a third China, Asia in general. If it goes below 48, we've got issues. Currently, it's at 50, 61, nothing to worry about there. Now, the TLT is the long end of the Treasury curve. If it's going up, that in general would be worrisome if we simultaneously saw oil crashing and the dollar rising. Today we have oil flat, Brent oil at 83. We've got DXY flat at 94.50, and we got the TLT getting a bid. So in general, I don't mind the TLT going up if the dollar's not going up and oil's not crashing. So that one comes with a caveat. I'd be more worried about the TLT falling and yields rising, which just shatters everything around it. Just really amazing what would happen if interest rates were to rise rapidly. So if the TLT, which is at 143.48, and we'll pull up these charts, goes below 140, that would definitely get me worried. And meanwhile, if Brent oil went below 75, I would get upset and believe we have a crash coming. Or the Chinese currency devaluing. These are all lines in the sand. The only one that's on red alert right now is DXY. So let's look at some charts of these. Here's DXY. You can see when I took the screenshot, we were at 94.44. Now we're at 94.50. Very critical level. If this breaks past 95, I think we have some problems that would force us to get to the deflationary camp and get ready for a stock crash. Best guess, this is on the verge of coming back down and making everything in our portfolio rocket. Imagine what's going to happen to the price of oil when the dollar's falling instead of rising. It could be very significant. Okay, here's emerging markets. You can see at 50, our level to get worried about is around 48. Nothing currently to freak out about there. The TLT is at 143. If we go below 140, I'll get my eyebrows raised. If we go to 136, we're going to be on a red alert. If we go below 136, I do believe it will crash stock markets and stop the sell-off in bonds because the economy is not recovering. GDP is crashing. There's no fiscal policy to support the bond market. So TLT going below 136 would be devastating to economics right now. Okay, here's the Chinese currency, the yuan. We can see once again, there's no devaluation of the Chinese currency. Their stock market seems to have bottomed out. So all we can really see are people who lent money to specific sectors of the Chinese economy. In this case, right now, it's the real estate developers are defaulting. So a lot of losses to people who are invested in that, but it's not spreading to their currency and it's not spreading to their stock market. So I believe we should ignore the risk of China thus far. And then here's a look at the Brent oil. Again, at a very important level here. If it breaks past 83, we're quickly going to see ourselves going above 100. And that's exactly what I believe will occur when we don't taper and we pass 2 trillion in stimulus in December. So our play on that is NRGU. We've doubled our money on that in about 3 weeks with a huge chunk of our portfolio long that ticker in every single strategy. And I believe that's going to be the most important long-term play right now. Now, if a true recession is coming, and it's not just mere market manipulations due to politics, I'd expect oil and other energy commodities to fall. Rather, energy is roaring to unsustainable prices due to high demand. So I'm watching for a sudden crash in oil prices to predict a deflationary spike. Shipping prices and times remain at record levels, but they're starting to cool off. No, Jeff, I think NRG is going parabolic to the upside as we pass these budgets. There seems to be a slow but steady reboot of global economies as the sickness slowly becomes less and less a burden on society. And my core prediction remains that we have a slow motion, multi-year rotation out of growth and into value. I'm expecting actually a 3 to 5 year bull market in energy companies. And this is where you need to have money placed. Let's just review the last few cycles. Dot-com bubble burst. Government took 2 years to expand deficits, but once they did, you got this rocket ship in XLE, the energy sector. This followed rates higher until the inflation led to a stock crash, house crash, and interest rates eventually crashed as well. So inflation leads to deflationary shocks. These cycles are lasting for about 5 years at a time. Okay, so we go crash the housing sector. This time we bail out the banks right away, double the deficit spending right away, and you get in this case, actually a 7-year bull market in energy. Okay, then we go create another, and then what happens? We put a populist president into the scheme of things. Corporations hate this guy. they immediately start to tighten monetary policy, and eventually this led to the perfect crisis when we locked down the globe in 2020. So now we're back to raising deficits, printing money, suppressing interest rates, and I believe NRGU is going to be your single best returning asset for 3 to 5 years. So no, I wouldn't be selling your NRGU anytime soon, unless we see some of these risks we've just reviewed play out, in which case oil will give us a heads up before that occurs. Okay, so when stimulus passes, which I believe it will in December, by mid-December, I'd expect in our pro strategy, EDC, which is emerging markets times 3, and EFO, Europe times 2, to greatly outperform the SPY, which we play with UPRO. And that's because the dollar is going to fall and the US is going to export all this money printing to foreign countries as they import all their goods and services. So we can see last time we passed 2 rounds of stimulus, you had dramatically better returns in emerging markets and European markets versus US markets by as much as a 50% outperformance. Guys, yeah, so a lot of questions about altering the trading plan. You know, my answer is always going to be follow the trading plan without exception. So yeah, I wouldn't outsmart the trading plan. The trading plan does this work for you, so you don't have to worry about it. Okay, the big expectation is for rates to rise and for us to have a slow motion growth to value rotation. It means tech sells off, banks and energy companies get the bid. Real simple. Let's look at this in practice. So the yellow line are rates back when we were passing massive stimulus. Green is energy and the candlestick is tech. Now what's critical here is that the stimulus wore off in about 2 months. Okay, so it took about 2 months and interest rates began to fall. Energy melt up began to fall back by mid-cycle of the year, and the bid for tech came roaring back in. Now, that's because we still had a lot of people not working. This time, I believe it'll be different. I believe we're going to get people back to work, and the growth to value trend will be far stronger next year compared to this year. So in general, I'd be worried about tech stocks flatlining and crashing, and the only way to make a good return being in these energy companies and banks. So in other words, right now may be the best time ever to start following all 4 of our strategies. We're actually expecting these assets to melt up with the dollar being this strong. Just imagine the returns we're going to have as that dollar falls. So, okay, great. If you're wanting to get a walkthrough of how to follow the trading plan right now, call Dean at 505-322-7515. Okay, great. We're going to jump into some more content now, and then we will go into a breakdown of exactly how much money is following each specific investment. Okay, very good. So in the first chart, we're looking at the QQQ in green, the NASDAQ in the candlestick, and the interest rates in gray. And so the main lesson here is that when interest rates are rising, you can see the green line goes parabolic to the upside. When interest rates are falling, in general, it wasn't right away, but eventually you got a crash in energy and you got a rise in the NASDAQ. So that's growth in the QQQ and value in NRGU. So it's important to have both because the economy is going back and forth trying to decide what's really happening here. So I do like having both in our portfolios, and we'll adjust the ratio as certain things begin to occur. Now for the growth exit, we're going to primarily be looking at reverse repo falling, signaling the demand for treasuries is falling. And then we're going to simultaneously be watching labor markets recover and the price of oil, okay, because those two really are in opposite trends. So important here is the second we passed stimulus, rates rose, tech sold off, energy got a bid. Then the stimulus began to wane, just like the medicine does, really quickly. And we weren't able to get jobs back online. And so you had rates fall, tech take off. And now what's happening? Rates are rising, predicting that exactly what I'm saying is going to happen. Stimulus passes, growth to value rotation occurs. So that's what the market's really predicting right now, as you can see. Because again, this has not happened. If the US were really to default or fail to extend the debt ceiling, rates are going to go much lower. There's going to be a huge demand for a limited supply of treasuries. It's really when we're going to pump treasuries into the market and oversupply the demand, we're going to see the rates rise. And again, that's exactly what the market's predicting here. Okay, in the next chart, we're going to look at the Russell 2000 IWM and the S&P 500. And so what we're primarily looking at in this chart is to see if IWM is going to lead the market higher or if it's going to fall. And so we can see it did just that early in the year, led the market higher, and then it's been trading flat since literally since February. So it's not giving us a signal of up or down. Okay, and I believe this all has to do with rates, with tapering announcement and stimulus passing. As soon as those are a done deal, I expect IWM to go higher and the stock market to go higher. Okay, here's emerging markets. Again, this has been under attack, smash and grab by the Communist Party. They started by, where's Jack Ma? Elon Musk was saying. So he was trying to speak out against the government. They made him shut up. They took out his insurance company, stopped a listing on that. Then they went to the education sector, outlawed private education because the Chinese were spending too much money on their children that they stopped having children. Then they started to ban video games, just on and on and on. Now they're letting big property developers bust on bonds held by foreigners. And now they're moving to the banking sector. So huge cleanup. Also, anybody dissenting against Xi is getting thrown in jail or just taken off the map. So he's consolidating power. A lot of headlines relative to Taiwan needing to submit. So those are the main things we're looking at there. Meanwhile, energy crisis in China, they are really having problems. So they're starting to put all sorts of restrictions on who can use how much energy. They kicked out the Bitcoin miners, as we know. So trying to keep inflation low so that they can feed nearly 2 billion people. Quite a task. But anyway, buy the dip. We like emerging markets. I think this will be your single best performing index this decade. So with Pro, we have massive exposure to it. With the EDC ETF, I'll probably be reallocating some capital to that out of the SPY and into EEM in the very near future, as soon as we get through this taper announcement November 3rd. If they don't taper November 3rd, I'll probably make that call and predict they do pass a budget. Okay, here's the European index loaded up with banks and retail and automotives. So very well set for inflation. I also think this will outperform the US markets in the coming decade. Very good index ×2, not the 3 times, but at least we get 2 times our money on it. And again, that's part of the Pro strategy. Okay, with our Bootcamp core and our high risk strategy, we're betting big on either Bitcoin or Ethereum. I like both a lot. Bitcoin acts like real estate, 21 million properties for sale, and then that's it. Ethereum I look at as Windows or Microsoft, early stage. So Ethereum could overtake Bitcoin's market cap if it gets the adoption. So right now, really the only big adoption have been these little pieces of art that are getting sold for insane prices, digital art. And then the other main one is Uniswap, so a ripoff of Coinbase for crypto on a DeFi. Other than that, we haven't really seen a lot of technology develop because the cost on a transaction Ethereum is outrageous, just extremely outrageous. They're moving towards proof of stake, which could do two things. One, it could open up the potential for Ethereum to actually have a lot of software developed with efficient cost basis and give it a huge advantage against Bitcoin. And then two, it could punish some altcoins like Cardano, Solana, and Polkadot, who are already on proof of stake. Now, the Trojan horse could be, what if proof of stake's not all that secure and allows it to get hacked? So as these assets grow, we're probably going to see 51% attacks start to emerge as these big pools of money want their specific cryptocurrency to dominate. So very interesting. We're playing the Grayscale Trust, GBTC, and ETHE. Bootcamp Core's got a huge GBTC position, and High Risk has a huge Ethereum position. And yeah, I think these are going to hit a short-term high by March of 2022, Bitcoin to 100,000 and Ethereum probably well over 5,000. And again, that's assuming no tapering and we pass those budgets. Okay. Next markets we're going to look at are gold and silver. What the hell is wrong with these guys? So not impressed at all. We've got the extreme negative real rates. What is that? So real rates is the bond interest rate against the inflation rate. It's super negative. Gold and silver should be going parabolic. Central banks are loading up on this. They're not getting any love whatsoever. Now, maybe in the short term, it's due to interest rates rising. It just seems like this is just not getting the attention it needs. So I have not increased positions on UGL for 2 times spot gold or AGQ 2 times spot silver. I like them long term, but they're just not getting the love they need. So keeping a close eye on that, but not issuing a increase in any of these positions currently. On the defensive side, there's really only 3 products I like to play a deflationary spike, which would mean a stock crash. So UVXY are out of the money put options on the SPY that are automatically rolled over for you on a weekly basis. Beautiful product. We're light on it right now if we're going to have a crash. I don't think that crashes yet. I think it's going to be either November 3rd if they taper, which I don't think they will, or in December if they can't pass a budget and we get lockdowns, which we'll see. We'll see about the lockdowns. We're seeing a lot of people are not putting up with this crap anymore. TMF treasuries, if we're going to not be able to pass a budget, it means there's going to be a lack of supply of debt that provides interest to banks. I think TMF could have a huge short squeeze and skyrocket higher. And then the dollar bursts higher. So it's at 94, but during the lockdowns, it went to 103. So we can make a ton of money. It'll be short and sweet with UVXY. We got to play that quickly, but you can make 10 times your money on that easily. TMF could very well go up 50 to 100% or more. Not a 10-time play, but a lot less risky than the VIX. And then the dollar, perhaps a 20 to 50% return with EUO. So those are the 3 plays I will put a lot of money into if I think we're going to crash. Right now, I don't think that's the most likely outcome in the short term. Okay, now in Bootcamp Core, we're playing some fancy markets. So these are some hot markets. REMX are rare earth metals. This has been a beautiful play for us. We've made a lot of money on that. It's tempting to pull some profits off our oil and gas play and buy the dip in REMX. Not making that call right now. What does REMX supply? Lithium for batteries and cobalt. So lithium for people like Tesla, just about any battery. And then cobalt is really useful for the batteries in iPhones. But there's something like 34 rare earth metals. They're used for your screens, just all the high-tech stuff we need. All the tech giants could be losing profit margins to rare earth metal people. So love that play. It's going to get worse and worse as we try to transition to more and more things using electricity instead of non-renewable energies. Uranium, we've not been playing recently. I should have bought the dip and got out of MJ, which has been a dud, as we had a huge spike today. Still waiting to make that call. Probably will wait to go long uranium till we see what's happening with tapering. Tapering could be very bad for commodities and energy and alternative energy. So I really want to see what's going to happen with that November 3rd before we start making a lot of moves. With Bootcamp Core, we got FNGU instead of the NASDAQ. That has 10 huge US tech giants and 2 Chinese. Love that. TAN, after having sold off all year, looks like it's getting ready for new moves higher. That's solar panels. Again, another Chinese play, a weak dollar play. And then MJ just been total dud. All the fundamentals for that space get better and better, but there's nobody promoting the stock. So I'm anticipating we will sell MJ and rotate that into the uranium play for those folks. Okay, there's a look at the dollar index. You can see how high it could go if we get a real problem. Now, the lows of the pandemic are currently, and this was just such a crazy move. See the dollar crash and then skyrocket up and then crash all the way here, and now it's rising. So keeping a close eye on that dollar. I think it's going to fall as we pass stimulus and don't taper. If I'm wrong, we need to totally change our allocations. Okay, if we're really having something break in China, I'd anticipate their currency to crash, which would mean the red line's going up. This happened every time we try to do tariffs on China and was met with volatility. All the Chinese currency's done so far, though, is strengthened. So it looks very strong. I don't see any reason to freak out about that. Here's that energy cycle. Again, we're just at the beginning of a brand new energy cycle. We do have a private equity offering for folks who want me to manage your cryptocurrencies. The plays I have you hedged against that you don't have with our portfolio builder products are the competitors to Ethereum, Cardano. We're not playing Ripple right now. Solana and Polkadot. Funny enough, Cardano and Polkadot were co-founders of Ethereum. Now Solana is just a huge operation being funded by venture capital out of San Francisco. These are the billionaires who brought all the tech giants to us. So good reason to hedge your bets on Ethereum with those three, absolutely. The other play we have is here with Polygon, one of the best performers of all time in cryptos. This is a second layer solution for Ethereum plus a bridge against between Binance and Ethereum blockchains. And then we have the DeFi for Binance Pancake Swap, which provides a 90% interest to stake. That's how we get a 1% dividend payout per month to our Rebel dividend investors. So very interesting if you want to get involved with that. Okay, let's just see what's happening. The trend I've been predicting for Rebel dividend investors for the last few weeks is that we are getting ready for a new move higher in crypto in general that will be led by Bitcoin, followed by Ethereum, and then pumped up and chased by altcoins. So that's exactly what we're seeing and how we were positioned. Primarily large positions in Bitcoin and Ethereum. As soon as we see Bitcoin get to new highs, I want to start to reallocate into the altcoins. So that's what I'm anticipating and to be the general trend. So very good. That's definitely happening. Okay, so let's look at some more risks. What about the sickness? Vermont is the most vaccinated state in the US, and it's not slowing down in new cases. So the medicine just doesn't work very well. I don't know how to say it differently. I do suspect this should fall very soon, and that the real risk is going to be late November. So yeah, very, very interesting to see Vermont having new highs. Israel, as we've been tracking, crashed as we expected, so that's good. Again, one of the most medicine places in the world. And Singapore, okay, another extreme medicine location having surging cases. So, do we believe there could be lockdowns this winter? Maybe, yeah, just maybe. Rate of change, as we anticipated, crashing. This will last for about another month and a half and then start picking back up into winter. So we can get worried about this when seasonality typically hits. Okay, so specifically, it's really December 1st when we're going to really be getting maxed out. So I think the risk is going to be after November 14th, which happens to be when we need to get the budgets passed. So very interesting. Jeff, it's just a brand new product. It's up 16% in the last week. $7 per share was the last price. Okay, now we know it's not a lot of, why are we still wearing masks when the whole world's taking the medicine that wants it? A lot of people are saying it's the variation of the sickness that's the root cause. Absolutely not. This really is a strong argument that it has nothing to do with variations, that it only has to do with how long ago you had the medicine. So UK reopened right after they finished the double dose with that variation spreading like wildfire, and it had no impact. So absolutely, the medicine works really well right after the second dose for about 3 to 4 months. After that, it seems to stop. In general, I think this is the last period of time we're going to really worry about this unless the medicine is blocking a long-term immune response. And unfortunately, I am starting to believe the medicine is indeed blocking or hiding your real immunity. So that's way too complex to discuss. We'll have a better idea of this after this winter. But that would lead me to believe that people taking the medicine are going to be needing to take it every 4 to 6 months. Otherwise, they're going to have issues. So what does that mean for mandates? What does that mean for labor markets? In general, it leads to us believing we're going to have to spend a lot of money at the government, keep rates low, extremely low jobs growth. Beautiful for the positioning in oil and crypto and stocks, and betting the dollar goes down. Now, assuming I'm wrong on that, India tells us, hey, we don't need any medicine. It will come, it'll infect everybody. It's not the end of the world. And then life goes on. And then maybe we don't need all these mandates into next year. Looking at the people in power, the drum beat gets stronger and stronger, more and more mandates. So unfortunately, I think we are headed towards a very good scenario for crypto. I know we got a lot of crypto fans out there. So yeah, maybe we see some extreme returns in those positions. Okay, now we're looking at the VIX term structures. So we're interested in where the dots jump the most, and that indicates where there's the greatest risk. So October to November, there's a big jump. November to December, there's a decent jump, and December to January, there's another big jump. So what are we looking at? We're looking at tapering in November as an extreme risk to stocks, and then we're looking at failure of passing stimulus in December to be an extreme risk. If we get through those two periods without those problems occurring, we could melt up all the way to March. And that's exactly what I believe is about to happen. Okay, this is where we look at reverse repo. This means banks are desperate to find debt because they need the interest the debt pays to service deposits, which have to be paid interest, which means the banks are loaded with the money. The consumer has plenty of cash to spend. It's very bullish, especially for tech, if this reverse repo remains elevated. I believe if this falls below 750 billion, it means we are either on a verge of a growth to value rotation or a deflationary shock. And both of those would lead me to reduce exposure to tech companies. So far, it's been range bound between 1.3 and 1.6 trillion dollars, showing us to remain long tech at this current time. Okay, when should we sell NRG? Well, probably not till its key holding hits a new high or gets close to it, which would mean ExxonMobil, XOM goes to 100. So we're not anywhere close, not anywhere close whatsoever. So the difference from here to here is almost 100%. So that means we could see a 300% return, or excuse me, a 200% return on NRGU before we want to even think about selling. And it could very well likely go to new highs when we look at the grand scheme of how much money is being printed globally, how little investment there's been into energy. So yeah, this is a beautiful setup for NRGU. So yeah, definitely not selling that right now, unless we think there's going to be tapering November 3rd. And then yeah, I would completely exit that position and go along the VIX, the dollar, and US Treasuries for a very short period of time. So instead of looking at leveraged ETFs, look at the underlying. Otherwise, you're going to think it's overbought when reality is it's still extremely discounted. Okay, this is extremely cheap. NRGU is extremely cheap right now. Let me repeat that. NRGU is extremely cheap at current prices. Okay, here is our favorite chart, and this is rates in yellow, oil in candlestick. These two track one another. What's right? Is oil about to tank and chase energy or chase yields lower? Or are rates about to spike and chase oil higher? And again, I believe it has all to do with tapering. I believe tapering would most likely make energy crash and rates fall. And I believe that because we don't have a robust labor market recovery to handle tapering. Now, on the other hand, if we don't taper and we pass stimulus, I think these rates are going to skyrocket up and oil heads towards 100, which I think is the most likely outcome. Okay, here's some more energy products to keep a close eye on. So we've got copper futures. Well, copper's not energy, but it's used in construction, obviously. And we have natural gas. So a little bit of a slowdown, but you can just feel how high these have gone. And so I believe, again, as long as we don't taper and pass stimulus, these are both going higher. Okay, lumber futures, after crashing for several months, back to getting a bid. So the inflationary theme remains intact. We got the Baltic Dry Index related to shipping, again at record highs. So no real signs of a crash coming. Now, here's a really neat chart. These are the 10-year and 30-year bond yields going all the way back to 1980. Imagine getting 15% to lend the US government money. Wow. Why would you do anything else? Massive, massive profits holding bonds over the last several decades. My prediction, just to be very short and sweet, is the highest we could possibly go is 3 on the 30-year, and then we head much, much lower. And I believe this will top out around 2023, because that's right after the midterms, when I believe we're going to tighten monetary policy to fight inflation. So I bet we top out in the first quarter of 2023 after midterms. There's lots of stimulus pushed through, that the $2 trillion in December is not the last stimulus, that this is going to be the only way the Democrats keep control, is they have to keep the money printing coming through to keep the votes on their side. And this is going to drive yields higher. And after the midterms are over, short, brief monetary tightening to fight off inflation, maybe push another big spending package through, and then prepare for the 2024 election race. So I'll be loading you up to the brim on bonds as we most likely break that 2.4 on the 30-year. I'll be building your position and we will max out if we get anywhere near 3. I'm not certain we can even handle 3. 2.8 might do the trick. And then it's going to start collapsing everything around it like a black hole, sucking everything in. Okay, how high can rates go? Really high. Gold copper ratio predicts that. You don't want to be long gold if rates are about to rise, and we're going to have a slow but sure recovery led by lots of fiscal stimulus. So are we going to get the labor markets back? That's what we really need to see for this ratio. We can just see how well this predicted rates all the way till you crashed real estate market, and eventually that led to a stock crash way over here. Okay, but you can see this began to predict problems all the way at 2006. Okay, the 3 critical bond markets I track are TLT, LQD, and JNK. If any one of these 3 are falling, that means somebody's going to have a hard time getting funding because interest rates are rising. I believe we can make a ton of money over the next 5 years shorting the junk bond market, but we should not begin that till about March. So at this point, really no big significant signs of stress. These rates are trading either lower, which means these are going up, or flat. So no funding problems for stocks or government. Okay, here's where we watch the incoming debt. This is the supply side of treasuries. As long as reverse repos at 1.3 trillion, I don't care how much money Janet Yellen wants to raise with auctions. Keep a close eye on those rates. But again, reverse repos telling us there's not enough. We need more debt to service deposits, which is bullish for tech. Okay, jobs, non-farm payroll was really, really sad. We'll see what comes out next month. It's going to be after the tapering decision. So taper and then have a terrible October. That would be an interesting mix. Keeping a close eye on that. Tomorrow we get the new CPI in. I think it's going to fall a little bit, which would help the argument to not taper right now, that the inflation's transitory. I think this will either flatline or go back up in the coming months due to energy, rent, and wages rising, just being a little bit delayed from September. So we're going to start seeing that come into the CPI. But again, it's not necessarily the CPI that matters. It's the reaction by the Fed and the government with spending and monetary policy that affects the markets. Okay, banks continue to grow debt. That's a good sign for how we're positioned. Credit continues to rise, even though it's slowing down a bit. Retail sales jumped. No crash in the consumer. Here's record level consumer spending. And again, reverse repos saying that could continue right now. Job openings fell a bit, so that was interesting. And we had 3.5 people quit their job looking for better pay. There's going to be a PPI coming out for US and China at the end of this week, I believe. Some people are estimating China's PPI could be 20%. So no wonder they're trying to pop these bubbles strategically in a way that's going to be a step back for a leap forward for their society, at least with the society the Communist Party envisions. Jobless claims remain elevated. Jobs are coming in and out, in and out. Wages are rising. So the inflation's really just still intact. Now, if we believe that the economy can handle inflation, we really need to see labor force participation rise. Very few people participating in the labor compared to the last 3 decades. We had a rise from 2016 to 2020, and we had a small stabilization from 2005 to 2008. Other than that, the amount of Americans who participate in labor has been crashing. And this is a huge trend that forces the government to increase deficits. So bet on your crypto if this is weak. If it's rising, then we need to completely change our outlook on markets. And again, I don't see anything that's going to make this rise with current policy. Trade deficit, new record level. This is just going to get worse and worse until we have a populist agenda, bringing back jobs to America. Very inflationary, very problematic for interest rates if this were all to occur in inflation. So I don't anticipate that. Maybe in 2024. So we'll worry about that as we get to the next election cycle. Okay, no crash in income despite the benefits ending. Some specific companies I look for trouble with. Apple looking good. That Michael Burry guy shorted Tesla right here, and boy, is he getting smoked. He was hedged against that with some call options on, I think, Google and Facebook. So he's probably not completely wiped out, but boy, oh boy, was that a bad play. I think you might want to sell Tesla around February, March, or potentially as early as December, as soon as that stimulus passes, because I think rates are going to go up and start playing havoc with tech stocks once again, like we saw last February, March. Okay, Tesla's too much exposure in a lot of ETFs, especially ARK funds. Now, Kathy's been dumping Tesla in massive quantity, but all of her portfolios, this long duration, high growth products that just get demolished by interest rates rising. So if this were to crash, this could create some systemic selling as well. Tencent, huge Chinese software company, stabilizing, that's important. And Alibaba stabilizing, also important. I like those two companies a lot long term. Okay, Samsung tanking, that's definitely getting some more attention here, but at extremely high levels. If it were to burst to this level, I would say buy that dip aggressively. We have exposure to this with EFO. So again, we'll watch this carefully. One of the only stocks that's really showing a sign of problems here. Toyota getting a bid back up. So in general, not a lot of warning signs. The only real warning sign is that DXY, which is impressive. To see the dollar rising with oil shows you how weak foreign currencies are currently relative to the dollar. Okay, China's PMI is bouncing back up. European PMI is still in positive territory. Chinese imports, record levels, exports, record levels. We've already looked at the European PMI. Core inflation in China is supposedly real low, but their PPI is extremely high. So we'll get that data on Friday. Explains why they are trying to shore up inflation. Here's the Fed's balance sheet. If they're to taper, this is going to slow down and flatline by July. They're saying they're going to stop tapering by July. If that happens and Janet is about to issue massive amounts of treasuries, it's going to be very problematic for commodities and stocks without robust labor, which again seems extremely unlikely until March of next year. ECB keeps printing away, although they're warning they're going to taper now. Bank of England was warning about rate hikes, so a lot of talk. We'll see if they walk the walk or if it's all talk. Okay, let's go ahead and look at some headlines in news. Okay, Pelosi says she's disappointed of the House not moving ahead with the $3.5 trillion deal, promises a smaller package will be transformative, and reiterates key decisions need to be made in the next few days. So they're just going to squish the timeline, lower the headline price. I think it's going to pass. Something like 10 to 20% of the military is refusing the mandates. Is this going to be a national defense problem? We've got airlines calling in sick, all sorts of issues, healthcare systems overloaded. So again, I think it's going to be a relatively weak labor market for quite some time. Great for tech stocks. Big thread there about the defense contractors and all sorts of problems developing from these mandates. 4.3 million workers quit their jobs in August. We have Texas saying it's against the law to make mandates, while federal government is making OSHA rules to force the mandates. So now what do you do? If you're a company, you're getting punished either way. Very interesting development today on that. Again, all pushes towards weak recovery of the economy. Great for crypto and tech. Some odds on the 2024 elections. We have Joe Biden, Trump, Kamala Harris, DeSantis, Mike Pompeo, probably the only one, Tucker Carlson, too funny. Yeah, I don't know who's going to run against. I think it will be Trump. I'm not sure who's going to run if Biden will. Biden's not looking good for the next term, so we'll see who they put up against him. We will see. Who knows? Long ways from now. A lot of cargo is shipped in passenger jets, so this is going to start messing with auto parts, medicine, garments, PPE, and electronics. More and more flights get canceled. So very, very interesting to see this beginning to occur. Jim Bianco's got a huge thread on that. He's also saying, why aren't people going back to work? We thought it was unemployment benefits, but now it's 2 weeks past, not seeing this recovery. So we will see. I think maybe a little more time for people to run out of money before that begins to occur. Here's a drop in property sales in China. Typically that only lasts for a month or two. It needs to go back up. Otherwise, China's economy is going to have some big problems, bigger threat on that. But again, we're not seeing the key markets were associated to cracking at all. This is looking at China's electricity use versus copper, expecting copper to fall. But again, we know China's been manufacturing a slowdown to try to curb inflation. And they're likely to slow these curbs down and recover their economy soon. So I don't think we should get too upset about that and exit our positions. This is looking at the return to the office, still at 50% levels. Jim Bianco is predicting this is long-term changes. We are realizing we don't need to spend so much time at the office. We might be more efficient at home. Daniel Lacali says the US dollar has rallied to its strongest level since November, not because of the Fed's prudent policy, rather the opposite, because of reckless twin deficit money printing of other countries. So yeah, if we saw dollar rising and oil crashing, that would signal a crash. Instead, we're seeing weakness in foreign currencies, pushing the dollar and oil up, probably all due to China primarily. George Orwell says, who controls the past controls the future, who controls the present controls the past. Boy, oh boy, are we seeing a pretty screwball media these days. Very, very interesting to watch people lose faith in their media. Moderna has no plans to share its recipe, go figure. Okay, so China's PPI print is on Friday. I've heard estimates of 20%, but they're looking at coal futures predicting it could be as high as 30%. Are they going to start to pass these costs down the food chain? Goldman Sachs says we'll have hikes starting in 2023. That's what I believe as well. And again, that's because that's after the midterms. Don't want to mess up the economy before the important midterms in the winter of 2022. Chai Girl, oil energy expert, says oil demand's just going to grow from here. So again, we don't want to exit our energy position unless we're going to fail to pass budgets or make a policy mistake at the Fed. This is looking at storage versus demand heading into winter. So yeah, energy could be getting ready to go parabolic for us. Chai Girl is saying China is no longer the buyer of last resort. We need to start rethinking this and prepare for the explosion of demand as far as materials are concerned that are coming from the West. So again, we're perfectly positioned for all of this. So again, inflation, you can hedge with the oil and gas play until the prices get unsustainable, the consumer rejects it, and then you get a big crash. Okay, very good. So we're about to transition to the portion where we reveal the exact breakdown of assets per strategy. And where if you're on a free trial that's expired and you're watching this on YouTube, you're going to get cut off. So this is where the video ends if you're not a paid member or you're on a free trial that has expired. So don't miss our next trade alert. We could be totally changing our positioning in late October before the Fed announcement of tapering November 3rd if we think they're going to make that policy mistake. Likely they will start to warn us through Bloomberg, through all these puppets they have, and warn us against it in the days leading into it. So they're telling us it's going to happen right now. I still think that's just all talk to try to fight inflation because they're not going to actually pull the trigger. So call Dean now at 505-322-7515. Okay, so very good. Now we're going to jump into the next portion of the presentation. So I'm going to stop the recording for the freebies.